In this section, we're going to talk about cash flow, really, and some of the key differences between cash flow in a traditional partner business model and cash flow in a volume-based business model. Let me start by sharing with you just an example of a cash flow comparison that looks at really what the cash flows are whether you purchase a solution in the traditional model or in a cloud or volume-based model. And this really just takes the example that we've used in earlier slides of a 10-user deal, software licenses in the range indicated there, configuration implementation of about 36,600. This is the traditional model, as compared to a subscription cost of $249 per user per month. And so, looked at from the customer's perspective, if they consume that solution in a traditional manner, say the 10-user deal, probably going to spend something on the order of $90,000 to install that system, and thereafter on an annual basis between software enhancements and maintenance, as well as just the additional technical support and administration that is associated with maintaining that system on their premises. They're probably going to spend something approaching $15,000 a year for that. Contrasted to what they would spend were they to acquire that solution in a subscription based model or a cloud-based model. They're going to spend less up front, is the simple fact of it. They expect to spend less up front. They're not willing to spend the same amount of money up front, precisely because one of the big attractivenesses of the volume-based model is simply that you avoid the need to tie up capital, and you also have the ability to consume this as an operating rather than a capital expense. So upfront costs are going to be less in a cloud or volume model, likely somewhere in the $8,500 to $35,000 range, really, for that same 10-user deal. But if you charge a subscription price of $249 per user per month, and it's necessary, I would say, in most cases, based on the extensive modeling we've done, to charge subscription prices, probably in that area, at least based on the modeling we've done, in order for the economics to be viable and favorable for you as a partner over the long term. From the customer's perspective, they actually pay more in annual costs than they do in the traditional model, but their upfront investment is significantly lower. So now, looked at from the perspective of the customer, this is basically how things stack up for them. In the first year, they spend less on that solution if they acquire it as a cloud-based or subscription-based solution. And in subsequent years, though, they pay more. Now, this depends, of course, on what the subscription price is, and those lines may be closer together or further apart, depending upon what assumptions you make. But as a general rule, looked at from the customer, when they consider a cloud-based solution or a volume or subscription-based solution, they expect to pay less up front, and they would like to pay less over time as well, but they accept that they probably won't, and that's the trade-off they make in terms of being able to preserve scarce capital and consume these offerings on a subscription basis as an operating expense rather than a capital expenditure. That's the perspective from the customer's standpoint. Now, this is what the picture looks like from the partner standpoint. It's obviously the mirror image, pretty much, of what the customer's view of things are. In the short term, as a partner, on a subscription-based deal or a cloud-based deal, you're going to get less money up front. And you recapture that cash flow over time, or that revenue over time, because in subsequent years you keep the subscription flow coming out into time. So your cumulative revenue is less in the early stages as you take less money up front and also absorb the cost of acquiring and setting up that customer. And at some point, the deal becomes cash flow positive to you, or you cross over, you start earning, you earn the same amount of revenue as you would have had you sold that as a traditional offering. And after that sort of crossover point, if you will, you actually get more revenue from having sold a subscription-based offering than from having sold a traditional promotional offering. Now, where exactly that point of crossover is, whether it's 18 months down the road, or 24 months, or 20 years, or anywhere in between, it depends upon a number of factors. But the fact is that you have to count on getting less in the way of revenue for a subscription-based deal or a cloud-based deal in the short term, in exchange for over time getting more in terms of cumulative cash flow and cumulative revenue. Now, that was a gain on an individual basis. Let's look at what the overall cash flow curve looks like for the transitioning business overall and all up. And this just will look at what the monthly cumulative cash flow will look like. Let's take two examples. And this is really just to, again, sort of reinforce the notion of you being able to do things to mitigate the cash flow consequences in the short term. If you take the example of all of your subscription-based deals, for example, or cloud-based deals coming to you on a monthly pay basis, so the customer just pays the subscription amount every month, month by month by month. They may have longer contract terms, but their payment frequency is monthly. In that example, you're going to be looking at a cash flow curve that somewhat resembles this. The precise shape of the curve is going to be different depending upon your business, but fundamentally, for a period of time, you're going to have to sustain some form of negative cash flow as you invest in infrastructure to transition your business to a volume-based model rather, as you invest in acquiring customers individually, as you invest in setting up those customers. You're going to have to invest monies and have a period of negative cash flow that will be recovered over time by the subscription amount. And in this particular example, that period of negative cash flow, sort of is at its trough, if you will, around month 14. It starts to climb back out of that as the subscription revenue builds, and by the time you get out to month 25, 26, somewhere in there, you sort of cross over to overall positive cash flow territory. And then, of course, the cash flow curve starts to rise quite steeply as you build a subscriber base and every month bring in more and more subscriptions. That's what happens really as you look at it from an overall business perspective. Now, again, the shape of these curves is going to be somewhat different depending upon your individual businesses, and we have extensive modeling tools that allows us to sort of look at that equation and optimize it for the partners that we work with. But each one will experience a curve similar to this in some respects, certainly in terms of its overall shape. Now, this gives rise, obviously, to the need for capital to be sourced to ride out the period of negative cash flow in the short term, or in the initial stages at least. And two main sources of that, as has been explained in other sections. You can either source capital from outside the business, or you can fund that short-term cash flow on the volume or subscription-based business model out of your existing traditional business. And for most partners, that's exactly where the funding really has to come from. But in any case, there's a period of negative cash flow that has to be funded in some way, either by cash flow from the existing business or by outside capital. Now, let's look at what happens, though, if you mitigate that cash flow equation by taking payments in advance as opposed to just a month-by-month subscription basis. It has some very significant effects. You'll see, first of all, that the level of capital required to make the transition to a volume-based business is far less. It's under a quarter of what it is in the earlier scenario, and you also become cash flow positive far earlier. So it dramatically lessens. So taking payments in advance from a cash flow perspective is critical for most partners. And more detail on this in terms of promotional offers, by the way. You can get more detail in the section on promotional offers, which really addresses how you structure your pricing to incent customers to pay you annually in advance as opposed to monthly in advance, and therefore dramatically reduce the cash flow consequences that you face as a business transitioning to a volume-based model. as well as dramatically reduce the capital that you require. But less capital required. Now, in order to get people to pay you their subscriptions annually in advance, as an example, you need to give them some incentive, and that incentive really is some form of discount. So they receive a financial benefit from doing that. And the discount that you apply, obviously, over time, lessens the total cash flow that you're able to get. So you're really, from a cash flow perspective, critically, through the mechanism of promotional offers and the payment frequency that you incent customers to pay their subscriptions on, whether it's monthly, whether it's month by month, quarterly in advance, annually in advance, you're really trading off cash flow in the longer term for a far smaller cash flow impact in the short term, and a far lessened requirement to source outside capital or to drain other cash reserves in order to transition your business to a volume to a volume-based configuration. I want to share with you some of our experiences and sort of, I guess, early conclusions in terms of what we see as being key to a monetizable outcome. Obviously, the only reason that you transform your business from one model to another is so that in the long run that business is worth more. In other words, you have to be able to monetize the business or sell the business in some form and have it be worth more, having transformed itself to, or you having transformed it to a volume-based business model than it was worth as a traditional business. And really, from our early experiences in that of partners we've worked with, one of the dominant challenges that we see in order to getting to a point of being able to make the business value increase significantly is going to be to get customers to convert to subscriptions outside of their regular replacement cycle. If you think about it, ERP systems as an example replace probably every 7 to 10 years. That replacement cycle is lengthening. So that means that something between 10 to 15% on average of all the systems out there are being replaced in any given year. If you can entice people to convert their systems to a subscription-based model in advance of when they would normally consider replacing it, you get obviously a far faster growing subscriber base, and that means that as the rate at which your subscriber base grows gets greater, you get more market momentum, you get market share faster, and that really drives out attractive valuation multiples. And we see entities in the cloud, and mentioned some of these in earlier sections, that are achieving that kind of growth, top line revenue growth, 20-25% plus. And a corresponding number in terms of the growth of their customer subscriber base. Those businesses trade at 4 or 5 times the multiples, quite literally, than we find the average sort of traditional partner business being able to being valued at in today's market. Now, in order to get customers to switch to a subscription-based model, earlier than they might otherwise need to, because they simply have to replace the system for whatever reason, obviously it's going to require a price point that is very competitive, and that is specifically competitive with what they pay today for maintaining their existing system, what they pay in maintenance of the software, what they pay in internal IT support, and what they pay to replace hardware. So really, in order to get the kind of market momentum that drives significantly attractive multiples, there's a need, as we've seen evidenced from players we've looked at, analysis we've done, as well as partners that we've worked with, to really get to a point of being very competitive from a price standpoint with your offering. And of course, in order to be competitive from a price standpoint with your offering, you need to have a very low cost structure in order to drive out an acceptable acceptable level of gross margins. And in most cases, this is going to require a very different cost structure from what is present today. And in other sections in this webinar series, there's more detail along the lines of what the key differences in that cost structure has to be. Let me give you a bit more of a specific example here, just sort of going back to our earlier example in terms of cash flow comparison, comparing a solution being consumed in the traditional format, a 10-user deal versus a cloud or subscription-based model, really in order to incent the kinds of conversions before a customer might otherwise be forced to convert their system, or in its natural sort of replacement cycle want to convert it. There's really a requirement to drive down the level of upfront costs, because the higher the level of upfront costs, it's really something of a barrier to them making the migration. The lower cost they have to incur to migrate from their existing system to a volume-based or subscription-based system, the more likely they are to do that. And there's also going to be a requirement to lower over time the estimated annual costs and to a point where they become competitive with really what the customer pays today in terms of software enhancements and maintenance, as well as the technical support and administration. There's really a requirement in order to get rapid penetration in any individual market to become as price competitive as you can be while still getting adequate margins. And that in most cases requires, in fact in all cases really, requires a very specific focus on getting your cost structure as streamlined as it possibly can be, cost structure in terms of what it costs you to acquire a customer, sales and marketing expenses, as well as what it costs you to set up that customer on your system and maintain them on that system. So here are some action items coming out of this section. For more guidance on dealing with the services erosion dilemma, ideas in terms of how you can configure your business to not be overly impacted, or at least to be better off in terms of able to maintain adequate levels of services margins, there's two sections in particular we would direct you to. The first one being the section on package and managed services to help you really get better services margins by packaging up services, selling them in a repeatable manner and in a manner that supports volume. The other section has to do with productizing IP, where you're able really there to codify your existing expertise, previous project code, domain expertise, those kinds of things, really produce that as a product, package it, if you will, as IP, and get the margins that are associated with software product, which of course are higher than in most, if not all cases, the margins available from services, particularly given the level of services margin erosion that we're seeing. Now, for more guidance on how you deal with the cash flow implications in transforming yourself into a volume-oriented business, recommend that you look at the sections on pricing and promotional models. Both of those really will contain a lot of information in terms of helping you being able to make the transformation with less requirement for outside capital, less requirement to drain cash out of existing reserves if you have them, less requirement to drain cash out of your traditional business, and really make the transition in the most sort of cost-effective and cash flow-effective manner, if you will, and really just sort of smooth the overall transition to a volume-based model. And finally, some additional resources for you to access in terms of being able to facilitate your transition to a volume-based business model. The first being Road to Repeatability training. You can find in there a wealth of information on this subject. Simply go to PartnerSource and search for Road to Repeatability training. The Microsoft Dynamics Partner Academy has a whole curriculum available for you that goes into a great level of detail on pretty much all of these subjects, various different webinar series and other programs you can access. So if you go to PartnerSource and search for Dynamics Partner Academy, you'll find those resources. And lastly, partner development centers are available really around the world in order to help you one-on-one manage effectively your transition to a volume-based business model. And you can find the one nearest you by going to PartnerSource and searching for Partner Development Center.